Welcome, everybody. Happy Wednesday to you. This is Institutional Trading Strategies, and I'm your host, Andrei Knight. And what I hope to do today is show you guys some recent market action, but show you the difference between probably how a lot of traders look at it and what a pro sees through their eyes. And I want to clear up some common misconceptions and hopefully give you a couple cool trade ideas to add to your repertoire. Some of the misconceptions, for example. An experienced trader sees more than you do. Now we're looking at the exact same thing you are. We can, based on experience, probably derive a little more meaning from what we're looking at. In the end, a green candle is a green candle, a red candle is a red candle, and a line is a line, you guys. I might have slightly different lines on my chart. I might have slightly more or slightly less of them. And mine might be a slightly different color than yours. But in the end, it's candles and shapes and lines. It's the meaning that I'm able to derive from it, you guys. And the meaning comes from experience. Which kind of touches on number 2. I need a special indicator. Some indicators are so much better than others. Kind of relates back to point 1, but it's not which indicators you have in your chart, but how you're using them. Or more importantly, why are you using them? If you can't tell me why an indicator is on your chart, what it's measuring, why you're using it in addition to other indicators, you're probably not using it to its full potential. You should at least be able to answer, what is it for? How is it used? What is it actually measuring? I wouldn't have both of these indicators on my chart if they showed me exactly the same thing, just in a different shape or color. Therefore, they must do different things or operate under different market conditions. And I'll go over, kind of in a nutshell, what everything on my chart is, why it's there, and what it shows that's different from other indicators. Third misconception. Professional traders must know the future. Well, being able to read a chart and trading in context sometimes lets you anticipate what's likely to happen next. And almost always, it lets you set up a conditional test to see if your idea is correct or not. But that's not seeing the future. I don't have some magic crystal ball that you don't. I have a way of analyzing the situation, generating scenarios from that, and then setting up a test or trigger to activate that particular scenario versus the other one. Or another one, I should say. Not all my scenarios turn into trades. Some triggers get hit, some don't. When one doesn't, I go back to work looking for alternate scenarios, and then setting up triggers to test those. It's kind of like being a detective or a scientist. You know, you come up with a theory, and then you come up with ways to test that theory. A trade comes when a theory tests positive. But not all ideas work out. It's just as important to see clues when to abandon the scenario and go looking for another one. But that's it in the end, you guys. It's not about seeing more. It's not about having fancier indicators or fancier lines. It's about being able to put that together into actionable ideas. Okay, probably the biggest difference between a professional and an amateur is that an amateur is chasing things all over the place. Oh my goodness, it's going up, I better buy. Oh crap, we just fell through the floor, I better sell this thing. Oh, I wish I was still long. You know what I mean? You're trying to follow the market through all of its twists and turns, instead of stepping back to look at the big picture. For me, a trade is a trigger that occurs in the context of a broader idea that I have already been expecting. I'm not chasing a trade. I'm setting up scenarios, and sometimes they work out and the price comes to me. And in those times, I like to be participating. And other times, something's not quite right. The trigger criteria aren't being met. So I cautiously wait in the sidelines to see what happens next. But you see the difference? I'm thinking in terms of scenarios, and then within those scenarios, more broader strokes moves. A beginner is often chasing the moves, and the problem with chasing is you're one step behind, and 2/3 of the time you're going to end up on the wrong end of it. So I want to show you guys how those scenarios get painted, and then how those scenarios, once defined, turn into trade ideas. And I want to share with you some of my favorite tools, which brings me to the last misconception that I kind of wanted to address today. And that is that you have to drop everything you're doing and start from square one the moment somebody shares a different way of looking at the markets with you. That's not true at all. In fact, I hesitate to call what I use a system, because it's really a collection of tools, but I'm always picking the most appropriate tools for any given situation. And I even have a selection methodology built in. But what I use in one situation may not be exactly the same thing as I use in another. I'll demonstrate some of the differences. In other words, I don't use all my indicators all the time. Some indicators are better at certain things or certain kinds of situations than others. It's about putting the right combination together. How do you know what combination you need? Well, each indicator fulfills a certain role, and your job is to look at the chart and be able to read the story that's happening there. You know, imagine how boring literature would be if somebody passed a law saying, well, you're only allowed to use 3 letters out of the whole alphabet. All writers have to choose from these 3 letters. Well, books would get pretty dull pretty quick, wouldn't they? No, we like to use all the letters of our alphabet. Just like I like to have all the tools in my toolbox available to me. But at any given time, I might construct only certain words or sentences and maybe not use all of them. Okay, so that's the analogy I like to use. You wouldn't limit how many different letters or words you can use when writing a book. So why would you limit yourself? Well, I found the perfect system. And that's all I'm going to use. Your indicators are green. My system doesn't allow for green indicators. I'm not even going to look at them. Find out what each tool does, and then mix and match them as the situation requires, you guys. So I'm going to pick for my example today the Euro USD. been in the news a lot lately. We've been trading it a lot this week. If there's time, Adi. But like I said, Euro USD. At first glance, this looks like pure chaos. We go up, we go down, we go up, we go down. Looks like it would have been pretty messy to trade. But I want to show you guys, there's actually a rhythm at work here. What we're actually doing, for the time being, is part of a sideways consolidation. And that comes on the heels of a long down move. And first thing I want to look at with you guys, and I'll teach you my tools kind of as we go along, as we use them. First thing I want to teach you guys is kind of the anatomy of a reversal. Okay, notice we made a lower low as we kept moving down. Our indicator failed to make a lower low. And if one wasn't enough, you guys, this is called a divergence, by the way. In this case, a bullish divergence. Bullish in that the second low we made had half the downward momentum. Yet it made a lower low. That's usually a sign not that a reversal is coming, contrary to what most people think, but that the end of a trend is coming. Whether or not it turns into a reversal in the opposite direction requires a couple more clues. Made another lower low, and the indicator once again failed to make a lower low. Two divergences in a row. Three bottoms in a row. Okay, this thing's obviously losing steam to the downside. But one question I want to pose to you guys, I like my classes to be participatory. We made a bottom here. We made a bottom here with a divergence, actually a double bottom with a divergence, and we made a bottom here. But why is it that this one ended up being the bottom? What do we have here that was missing here? You get what I'm getting at? Why did this one turn into a bounce and started going the other way, and this one was just temporary support? Just want to see if you guys can spot a few things, because not all bottoms are created equal. Okay, Janetta and Chris, you say candle formation. Very true. There was a doji here with a tail sticking out. It's not, by the way, just the doji. Okay, something you need to know about these guys, it's the open of the candle after that solidifies the candlestick formation. In this case, we're opening above the crossbar. See that? That's what makes it a reversal. Because when you open above the crossbar, it's likely that you're going to go up. If you go up, you form a green candle, and red doji green is what actually makes a reversal. Okay? Sometimes a doji, just FYI, can be a continuation symbol. But look at the difference here. We opened below the cross of the doji, or maybe a better way of saying it, we opened on the opposite side of the cross as the preceding candle. See what I mean? Opposite side of the cross is a continuation signal. Same side of the cross as the preceding candle is usually the mark of a reversal. So we had the candle formation. Okay? But you guys, look back here. There was an engulfing candle back here. I would call that a reversal candlestick formation. And a bullish open after that bullish engulfing candle. So this also had a divergence and also had a candlestick formation. There must be something more. Can you spot it? It's a teeny tiny detail. You know, I was just checking that. Hua Forex. It's about the same as this low. Volume's kind of been going in cycles. It didn't give a noticeable divergence on this doji. Okay, it is one of the things I normally check for, but in this case, that didn't give a reversal signal. You are close, Ian. You're pretty close. You know, sometimes it's good to compare what an indicator is doing with another indicator. Okay, stochastics turned bullish here, just like it did here. Okay, maybe here a little bit more convincingly. Okay, but you see that primarily in hindsight. This looked like it was starting to reverse as well. Back here you didn't know that it would come back down over here. You know, this one looks like it struggled a little bit more, but at the time this would have looked just as bullish as this. So you're close. There you go, Mr. C. Great, you guys. Little tiny detail. Look at each of these bottoms. Here, here, here. Your higher time frame stochastic is red over green. It's still bearish. When we went to make this bottom, we're flipping from bearish to bullish on the main stochastic, but the difference is we're flipping to bullish with the higher time frame stochastic, green over red. See, it doesn't have to be at the same time. This one flipped first, then flipped. Then this one flipped. The point is you're in alignment with the higher time frame. You're trading, in other words, in the direction of the longer term trend. It's part of the reason I picked on this example. I'm always talking about multiple time frame analysis. Now you get to see it in action. In both cases, you have a divergence. In both cases, you have stochastics turning from bearish to bullish, kicking off a wave in the other direction. The difference between this reversal from all the ones that preceded it is that the higher time frame is shifting with it. Okay, it's in agreement with the longer term trend. And yes, you are correct about the open inside the tunnel of fives. Yet another thing pointing to a reversal. Here we had the bullish engulfing candle with a bullish open, but that open is still outside the tunnel of fives. Here we have a reversal, and we close inside the tunnel of fives, and open inside the tunnel of fives. Now let me explain a little bit about my tools and the significance of this. And by the way, if you guys are wondering which of all those reasons you guys listed, by the way, great job, everyone. If you're wondering which of those reasons or indicators is the most important, that's not the point. The point is that we got all of those signals pretty much at the same time. You see what I mean? And that's what screams reversal. More than one alarm going off. Okay? The tunnel of fives, you guys, is basically kind of my buffer or noise zone. Okay? What I use as the middle of my chart is a 21 exponential moving average. It happens to be my personal favorite one. It's not because there's 21 average trading days in a month or 21 most active hours in a 24-hour forex day if you combine the American, European, and Asian sessions. It's not because it's a Fibonacci number. It's simply because, you guys, I've tried the 20, I've tried the 22, I've tried the simple, I've tried the exponential. This one gives me the most reliable results the most often. That's why. I would if I knew it, Amit. I unfortunately don't know. Maybe the FX Street admin can chime in here. As far as I know, you just have to create a free account on the fxstreet.com website, and as long as you're logged into the website, you'll see a join button to join this particular conference. But I'm not aware of any special event password aside from, being already logged into the site with your user account. And that you just create. If somebody knows otherwise, please let me know. 55, incidentally, Leonard, is another Fibonacci number. But the 21 is kind of my center, you guys. The tunnel of fives is built on a pair of 5-period smoothed moving averages. It's kind of a different kind of exponential. Like an exponential, it puts more emphasis on the most recent price action. The difference is that it uses for weighting is slightly different. As the name suggests, it smooths it a little bit. So it's not quite as erratic. If your charting platform doesn't have a smoothed moving average, you can go ahead and use a exponential moving average for this as well. But usually there's a shift box. You would just enter a 1 in there. Okay, so smoothed using as is, exponential shifting 1. Okay, and it's 5 periods, hence the name, tunnel of fives. The only difference is, like our 21 EMA and most of our moving averages, we apply to the close. Okay, of however many preceding candles you're averaging. With a smoothed moving average, we're going to take a pair of these moving averages, 5 periods each, and we're going to apply 1 to the highs instead of the close, and 1 to the lows instead of the close. And that's what creates the tunneling effect. I'll get to that, Drew. Focus on the indicator I'm explaining at the moment. Okay, I'll explain each of them in turn and how they work together. And remember, you guys, it's not the indicator. Like I said at the beginning, it's the principle. What is that indicator measuring or telling you? Okay, and ultimately, what meaning can you derive from that? The tunnel of fives, in terms of meaning, is my buffer along the 21. You'll notice sometimes it's below it, sometimes it's above it. Sometimes it's right next to my 21. Sometimes it gets pretty far away from it. Okay? It's a buffer. And the buffer works in several ways. For example, here, you notice we're riding the tunnel of fives, Once we open inside of it, yeah, we had this false move. This was news, by the way. That's why the candle's so much longer than the preceding ones. But we had this kind of sucker move to get everybody buying and going in the opposite direction before it reversed on us. But the open kind of gives it away, you guys. It's an open inside the tunnel of fives. It's an open below the cross of the doji, on the same side as the preceding candle. See that? There was actually a clue that a reversal was coming. But now, even if you see that, and your system says this should be a short, you guys, there's no reason to pull the trigger on a short if price is moving up. Why would you do that? Because the moment you enter the trade, you'll be in the negative. If you know it's a short and price is moving up, you sit there with your finger on the button until it stops moving up and starts doing what you expect it should. Okay? But this thing said short. Yeah, but price is rising at the moment. So hold your horses. Every second, the price gets better and better for your entry. You get closer and closer to potential resistance, i.e., a good place for your stop. So what could be better than moving closer to your stop, reducing your risk, and moving further from your target, increasing your potential profit? Okay? So one way we use the tunnel of fives. Once you go into the buffer, the trend is usually over. Okay? Which is one of the things that triggered this reversal. Right? Something we didn't have on this reversal. Here we stayed outside the tunnel of fives. I call those temporary retracements. Becomes a reversal when you close inside the tunnel of fives and a new candle opens inside the tunnel of fives. Likewise, the tunnel of fives can be used to kick off trends. Because when you cross to the correct side of the 21, you get an open on or outside the tunnel of fives. That's usually the start of a more prolonged move. As opposed to chopping that's taking place inside the tunnel of fives. You know why this one never took off, even after bouncing off of the 21 as support? Because we never opened outside the tunnel of fives. You guys get the idea? Think of it as kind of a noisy no-trade zone. I like to take my trades on the correct side of the 21 and outside the tunnel of fives, and I like to abandon my trades when we start trading back inside of it. Arnold, yes, always wait for the close. Anytime you make a decision in the middle of a candle, I'm going to say to you, you made that decision without any foundation or proof. Yeah, but my indicator just reversed and turned back up. But how do you know it's going to keep looking up for the next 40 minutes and not come back down if price drops? You see what I mean? Whatever your reason for entry, there's a big chance it won't be valid by the time the candle closes. So you make your decision when a new candle opens. Okay? If you absolutely can't wait, go to a lower time frame, wait for a candle to open there. But never judge a candle that's still in the process of forming. Never judge a bar on your indicator that is still subject to change. Our decisions are made based on the open of the candle after relative to what has come before. Because that's never going to change. Candle might move up, it might move down, but its open point, just like here, that'll never change. Even when this was a big, bright green candle near its top up here, its open was still below the cross of the doji. And an experienced trader would have noticed that little detail and would have been waiting for us to find some resistance and turn back down. Now, in this case, I was advocating executing the decision, Arnold, whenever we lost the upward momentum and turned back down. Okay? But executing a decision is very different than making a decision. I encourage you to make your decisions on candle open and then execute at the best available price. You see what I mean? Just like if you're looking to buy and price is dropping, let it drop. It's going on sale. You know how many negotiations I've won, Arnold, just by staying quiet and letting the other person talk? Especially if you're buying a car or something. The more quiet you stay, the more nervous they get, and the better the offer gets. You know what I mean? Seriously. Same thing can be said for trading. Let the markets do their thing. You have the big picture. You know what's happening. Let them do their thing. The way they react to your indicators will either prove your theory or disprove it. Either way, that's useful information. If it proves it, you get into the trade. If it disproves it, you analyze again, look for a different scenario, and then wait for proof of that one being activated. I do use multiple time frame analysis, Leonard. And this comes back to the stochastics question that DZ Bista had. Okay. All this is kind of showing me what's on a higher time frame, DZ. If I go to the daily chart, okay, here's that reversal that you were seeing. Actually, it would be this one. Right, it's daily. That's that reversal you were seeing on the second stochastic. Okay. That's all it is. It's showing me what's happening on the next higher time frame. Okay? You can see the same thing by just going to the higher time frame. So, Leonard, yes, I do. And actually, I'm doing this in reverse order because I wanted to show you how chaotic something can look first, and then I'll show you how you can trade it, even when it seems, you know, choppy and kind of pointless. There is actually something at work here. And you discover these things, you discover these scenarios by looking at the larger time frames. What I like doing, Leonard, is I'll look at my weekly charts at the start of every week, Sunday night. And I look and see what looks like it might be setting up. You know, some things look inconclusive. Okay, I'll wait another week to trade that. Some things look like they might be setting up for a reversal or might be setting up for a new trend taking off. Those are the things then I study every morning on my daily charts. And same thing. Some daily charts won't look quite ripe yet. I might come back to those on Tuesday or Wednesday. And then either upgrade them to I'm watching this chart today, or downgrade them to okay, I'll come back to it next Monday. Based on what scenarios I see or don't see forming on the daily chart. And then of the setups that look likely to go today based on their daily chart, Leonard, that's what I watch on the 4-hour chart. 4-hour chart, remember as I hinted here, tells me the current direction. And once I have a current direction that matches with a scenario I was expecting for the day from the daily chart, I then zoom in on the hourly chart and look for an entry trigger in that direction. It's got to agree with the higher time frame trend. If I get an entry signal in the opposite direction, I ignore it. There you go. You're already ruling out half your trades. Isn't that great? In terms of decision making. It doesn't mean I'm not allowed to change my mind, Leonard, or that I have to be a bull or a bear the whole day long, but it's that if I see reason to consider changing my mind in terms of direction, I verify it back up on the higher time frame. And that's how I avoid some of the whipsaws and zigzags back and forth. See, I think what a lot of new traders, where they fall short or where they run into trouble, is that they try to catch every wiggle up and down. Well, that's truly a game of chance. See, I'm not convinced scalpers necessarily make more money. The best scalpers I know make close to the same amount of money as swing traders. They just work a lot harder for it. And that's the best scalpers I know. Most scalpers I know are breaking even or losing money. It's just the more predictions you try to make, the more margin for error there is. What I try to do is I try to catch the broader strokes, you guys. Even if I don't catch the very bottom, and maybe get in somewhere closer to here, and even if I don't catch the very top, and reverse somewhere closer to here. I'm still catching a lot of meat from the middle. But by going for the broader strokes, A, you make decisions less often. There's less chance for making a mistake or being wrong. And B, you smooth out a lot of the noise. And that's where the higher time frame kind of comes in, right? In both cases, the main stochastic swung from bearish to bullish. The difference is here they did it with the support of the higher time frame already behind them. And again, they don't have to flip simultaneously. First the daily flipped, then this guy flipped. It's the fact that this one went to bullish with double the support behind it. Okay, let me talk a little bit about the indicators under the chart. Dhruv, I promised you I'd get to that. The indicators under price tell me several different things. First of all, I've got volume. Volume measures participation. We got more selling, we got more participation. That tells me more people are interested in selling this thing. The moment we go up, our participation dies off. Okay, not a lot of people are interested in buying it. That means probably we'll drop again sometime soon. The moment we start dropping, volume starts increasing. Aha! More people are interested in participating to the bottom, to the downside than the upside. Okay, so volume kind of tells you level of enthusiasm or amount of participants, and whether more of them are bullish or bearish. You know, you see that based on when it accelerates, when it decelerates. So volume measures participation, Dhruv. This indicator is called OSMA. It's very similar to a MACD. In fact, you'll notice I use the same settings, 12, 26, 9, as a MACD, the default MACD settings. Which kind of goes back to the very first point I made. It's not which indicator you use, it's what it's telling you. OSMA and MACD in some ways look very similar in that they're a histogram. In some ways they look a little different. This one's got 4 colors instead of 2. But what they're telling you is actually essentially the same thing. OSMA and MACD both measure momentum. Now I care about momentum, in other words acceleration or deceleration. I care about momentum when I'm in a trend. Right? Is the trend accelerating or decelerating? Seems like it'd be useful information. This is ADX. I'm once again using the standard setting 14. ADX measures strength. It's not necessarily bullish or bearish. It's neutral. That's why I color it blue. But when it goes up, the strength in the current direction is increasing. When it goes down, the strength in the current direction is decreasing. One of the things we didn't talk about in this reversal, we lost all of our strength. And by the way, the difference between a trend and a range, you guys, notice, while we were trending downwards, ADX spent most of its time above 30. 30 is my cutoff line. We had a strength greater than 30. When we fell into a sideways range, we crossed below 30. Remember I said not all indicators work all of the time? Here's one key difference, you guys. Think about what a trend is. Higher highs, lower lows. That's how we usually define a trend, right? Either higher highs or lower lows. What does that imply, you guys? A lower low or a higher high implies that you're breaking past a prior support resistance level to make a new support resistance level. Or in other words, a higher high or lower low. Breaking through resistance or support requires a certain amount of strength. And if you don't have that strength, if your strength is below a certain level, chances are when you hit that support resistance level, you're going to bounce off of it instead of breaking it. And when you're bouncing back and forth between two support or resistance levels, we call that a range, don't we? You follow me? So ADX measures strength. Okay, an important piece of the puzzle, Dhruv. You've got participation, momentum, and strength. Together you paint a complete picture. right? But when you don't have strength, you're in a range. Momentum's pretty meaningless when you're bouncing back and forth between two levels. I don't care how fast I get there. You know what I mean? When I'm bouncing back and forth between two levels in a range, and then they need not be, by the way, horizontal ranges, you guys. Some ranges slant slightly upwards or slant slightly downwards. We call those channels. The point is you're bouncing back and forth between two support or resistance levels, even if it's a diagonal trend line. When I'm bouncing back and forth between two levels, it's obviously helpful to know which wave I'm in, bullish or bearish wave. So I switch to an oscillating indicator. This is the second kind. Okay, I prefer stochastics, you guys, but you could just as easily substitute the stochastics with RSI or with CCI, and it would tell you the same thing, just in a slightly different color. You know, instead of 20 and 80, you would use 30 and 70 for your oversold and overbought zones. But you would use it the same way. You could substitute a CCI in here, Commodity Channel Index. Only thing that would change is this would be negative 300, this would be positive 300. But you would use it the same way. All oscillating indicators work alike. They just display their information in a different color. All momentum-based indicators work alike. They just display their information in a slightly different way. ADX kind of functions as an indicator selector. That's why I have it in the middle. When it's over 30, I have enough strength to make new highs or new lows, and therefore I'm in a trend. Therefore I want to monitor the momentum of that trend. When I'm in a range, ADX lacks the strength to break support resistance levels. I want to know which wave of the bounce I'm in. You see, you guys? It changes based on the situation. Okay, so that's some of my tools and how I use them, and I think you kind of start to see how I use them in combination, like pinpointing this reversal, because they all kind of fired at once. Okay, now let me show you how we use these tools in combination with each other to come up with and define scenarios, come up with trigger tests to either activate that scenario or pass on it, and then from that build a trade. Okay, as I mentioned, I like to start off my weeks by studying the weekly chart. Big picture first. Then I go to the daily. Where am I within that picture? And very important point on multiple time frames, Leonard, top down. I'm kind of doing it in reverse order today, but normally you go top down. Start with the big picture and zoom in. Okay? Well, big picture, here you see it even on the weekly chart. We made a divergence, and then we actually made a second divergence. The difference between this one, the reason this stuck, and this was pretty much the turning point, and we've been going up since then, it's not because it's the second divergence in a row. They won't always come in pairs. It's because you've got the flip of the higher time frame, reinforcing it. Okay? And of course, well, this is a pretty long-term support level. This is a monthly 200 moving average. And we just bounced off of it as support, as the monthly stochastic flipped. Okay, so that was the bottom of the euro. Once we knew we were in an up move, we had to figure out roughly how far it would go. Those of you who were with me last Friday for my Fibonacci class, you know my favorite tool for that particular question is fibs. And if you weren't here, by the way, with me last Friday, we'll be doing another one on Friday, June 7th. Okay, so mark your calendars and please join me. We'll take a closer look at how to use fibs. But just real quick, if we want to know how far a trend will move, we measure its first wave. meaning how high we got before the first significant pullback. Okay? I measure from the beginning to that top. And this is the only thing I do. I will only worry about 2 points. The computer or the indicator figures out everything in between. Our reversal happened in this case on 38. This was the Fibonacci retracement. You might say, but aren't we closer to the 50? We are, but we're not rounding off. Okay? You go by the last level actually touched or crossed, no matter how close you get to the next level. The last level touched or crossed. And the last completed one was 38, so we know our high is going to be somewhere around 138. Okay, and in this case, support did not hold, so we didn't activate the bonus round to go to the next fib level. So this fib completed, just giving you guys an idea of the big picture how we came to here. And then since completing, oh my goodness, guess where we retraced to? Back to the 38 we originally started from. And in this case, look at those wicks. Nailed it pretty darn close. And the spooky thing about fibs, you guys, remember this is a weekly chart. 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks later. And this is a fib I drew on the weekly chart. Let me show it to you on an hourly chart. The support we found late last night during Asian session. Look at that doji, you guys. The cross of that doji is right on one of those weekly fib levels to the pip. Look at this resistance to the pip. Look at this support. I haven't moved my fib. I drew it on a weekly chart. It's still relevant 9 weeks later on an hourly chart. Heck, I could probably zoom in further. If you're still not convinced. Yeah. 5-minute chart. Look at that. Okay, so that's one thing that's in play right now on the euro, you guys. Okay, I'm conscious of this basically 2,900. Might as well round it off. It's so close to the round number. But we keep coming back to this level, either as support or resistance. The other thing that I'm keenly aware of on this chart as I look at it, you guys, there's a trend in play here, or a trend line, I should say. Notice the 2 prior bottoms. I'm going to take a simple line and draw it from the body of one of the bottoms to the body of the other bottom. And lo and behold, it predicted the third bottom perfectly. As a matter of fact, as I continue to zoom in, okay, I want you to see something already, what I knew at the start of this week on Sunday. Oh, we found support, we're moving up towards resistance. I knew that already Sunday night with this open. I didn't know Friday afternoon that this is what it was going to do Sunday night. That's predicting. I just knew we had come back down to support. But I still had to see what we would do once we hit it. Okay, you see the difference between knowing the future and knowing how to use your tools? Based on the reaction, yeah, I knew what was coming next. Predicting the future is trying to predict the reaction. Here again in the zigzags, trying to catch absolute tops and absolute bottoms. I'm not in the prediction business. I'm in the recognition and taking action business. So weekly scenario was we bounced off the bottom right where we suspected it might be. So naturally we're moving up. Our next job is to find potential resistance. Okay, and there's 2 things I can focus on. One's not relevant because we're away from it, but that would be connecting the 2 most recent tops, again the bodies, just like I did the bottoms. And remember, this trend line is off the weekly chart. Look at how the daily chart is behaving. verification of a theory. Okay, so in theory, we're kind of consolidating in this triangle, but in practice, our 21 is holding us back, acting as resistance. It has several times previously. Actually, you could go back even to this wick back here. The 21 seems to be holding us as resistance. Well, great. Can you guess what I entered into today's trading with on my mind? We hit the bottom. It bounced us here and here. We hit the bottom, stopped above it. We opened above it. Okay, today is going to be about going long to the next anticipated resistance level. Okay, I did my weekly analysis Sunday night. I did my daily analysis this morning, and my daily analysis was I'm buying every time we bounce off of this line, and I'm selling. This is that daily 21 up here. I'm selling at this line. So I didn't catch the very top of this wick. I didn't catch the very top of these bodies. But look at how many times I was able to repeat that trade today. This is that same chaotic 4-hour chart that I showed you at the beginning of class. But look at how much more sense it makes sense now that you know there's a long-term support level. Now whenever you get this bounce, remember this doji? Remember this open inside the tunnel of fives? It was also the first open establishing this line as support. And now you know from your longer term analysis, it's not so much the 4-hour 21 that we're concerned about in this case, right? We're falling below 30 on the strength. We're forming a range. Where's the top of the range? No, we know from our daily analysis that the daily 21 is what we've been coming back to lately. Oh my goodness, there's your trade. What? Doji reversal? Great. Remember I said wait till this turns down? How about wait till it turns down and the daily 21 fails to hold as support? May not be the top tip of the pinprick, but what about if you sold here back down to this trend line? At which point, when you got a reversal candlestick formation, a bullish open inside the tunnel of fives after a bounce, you buy again, back up to the 21. You see, the same chart I showed you guys at the beginning of class, but now it has meaning. Now it has context. Now feel free to go and use your favorite indicator and trigger an entry, provided it gives you a bullish entry trigger where you expect it. And if it doesn't, you wait. And if you wait another candle, another candle, another candle, and you don't get that bullish trigger, maybe it's time to zoom back out to a higher time frame and formulate a new scenario. But I'm setting up scenarios, and the trade either comes to me or it doesn't. I'm not chasing what seems to be a reversal or not in the moment. You see, my trades have context. All right, I'm going to take some of your questions in the last remaining minutes. I'll get through as many as I can. Real quick, you guys. An hour goes by pretty fast together. Here's how you can follow up. Here's our Twitter, Facebook, if you'd like to follow what we do. Now, I grazed over my indicators quickly just so I could cover them all in an hour. There's obviously much more to how I make my decisions. I hope you've got a general overview. If you want to get more specific, you can learn our entire system, and we're offering for the summer some discounting price to kind of motivate you guys. Think about what your last losing trade cost you. We're much cheaper. Okay, if you want to learn the entire system via pre-recorded workshops, it's actually a series of them, and we also get into psychology, money management, probability, all that good stuff. Visit that link there. You'll get 20% off for a limited time. If you're more of a hands-on kind of work with me, coach me kind of person, Got great news for you. What we do today, you guys, what we did together today, we do every single morning. In fact, we do it twice a day. Once at the beginning of the trading day, once at the end of the trading day. And instead of looking at just one pair, we usually look at 5 or 6. We set up our trade scenarios for the day together, and at the end of the day, we get together and evaluate what we actually traded, what worked, what didn't, and what could be done better for next time. And we do that every day, twice a day. And for a limited time, we're offering that at 35% off. Okay, second link. If you're low on time or low on budget or both, we also have what we call kind of the economy plan, the weekly video updates. This basically gives you just the recording of the Monday morning live session. Why the Monday morning one? Because that's where we set up our scenarios for the week. Remember I said I look at the weekly charts at the start of every week. So we kind of give you a broad strokes overview of what to expect from the coming week. You can't ask questions, you can't interact. But look at the price. You also can't argue with the price. Okay, it just gives you a weekly overview to get you started. And if you're not sure if you prefer the recorded system or the live system, you guys, great news for you. If you subscribe to the live training, you get the recordings for free. If you get the recordings, you get a discount on the live system, so you eventually earn back the money and savings that you spent on the recordings. Okay, so however you choose to approach it, if you decide to get the other product, you kind of get your money back. Okay, so that's what we offer. And just visit fxtonight.com in general, you guys. There's a lot of free resources on the website. Indicators and plugins for MetaTrader, chat room, forum, training videos. Okay, all sorts of goodies, streaming news. And while you're there, sign up for the newsletter. Okay, so the next time we do one of these webinars, we can send you an invitation. Okay, so that's what we do. Let me get to just a couple of your questions. There's no cost for the website. 95% of it is free, Emmanuel. The only things we charge for are what's listed here. You know, if somebody wants further training. Basically, the information I make available for free, my time is what I charge for. 95% of the website is totally free. The daily training at sale price is £129 per month. Okay, like I said, roughly the cost of a losing trade for a whole month of trading. Price action is neutral, correct, Leonard? Inside the tunnel of fives means we have no decipherable trend yet. And that's correct, Jeanette. The DVDs are pretty similar to the recorded workshop. One gets you a physical product, one you watch online. On the other hand, one you get instantly, the other one you got to wait for. But pretty much the same content between the DVD and the workshops. I explain each of the indicators. I start with a blank chart, and I build it up line by line, indicator by indicator, and basically explain in detail what it is, why it's on the chart, and what we're looking for when we read it. And then I put it together into the complete system. And then, like I said, I also delve into psychology, money management, probability, all that other stuff that people often overlook that I think is actually more important than what indicator you use. Leonard, you were asking about the stair-stepping of the higher time frame. If you think about it, that's their nature. You know, you have 6 4-hour candles in one daily candle, right? So for 6 4-hour candles, the daily chart is going to read the same value for 6 candles in a row. And then it's suddenly going to move when you have a new daily open. And then it'll stay put for another 6 candles. That's what creates the stair-stepping effect. because it's a difference in time frames. I plan my trade. Last question I'm going to have time for, Emmanuel. That's correct. I plan my trades from the weekly and daily charts. I confirm them on the 4-hour chart, and I execute on the 1-hour chart. That's kind of my top-down procedure. Alrighty, you guys. Thank you very, very much. I hope this was useful for you. Like I said, I'll be back Friday, June 7th. We're going to take a closer look at one of the tools in particular, the fibs, and how to use them to predict the length of a trend and likely reversal points. I'll see you then. May the rest of your week be profitable.